I am Benjamin Gan. Welcome to CS206 Software Product Management. This module is on strategy. We will cover 5 topics: strategy, ecosystem, financial, and we will quickly cover KPI and risks. Let's begin. Why have a product strategy? In software, the pace of change is very fast. So your strategy can have far-reaching decisions that can affect your financial and product survival. So it is important to plan ahead, usually in a time span of 1 to 5 years. And it also helps to align all the stakeholders, the sales, marketing, as well as the development team and the product management team. Product strategy involves the customer and the market. Let's start with the customer. There are two kinds of customers. The paying customers, which the sales and marketing group will handle, and the users, and the product management group will handle the users. And there is a customer life cycle. Throughout your product life cycle, you have to manage the customer in different stages of your product life cycle. So during the beginning, in the introduction or the development stage, you need to acquire the customer. So you need to keep them aware of your value and gather information to improve your product. As you grow, during the growth stage, you want to maintain support and personalized communication to continue to provide value. When you reach a maturity, you need to maintain your quality using service level agreement or SLA, and provide programs such as loyalty and VIP programs to maintain and sustain your user base. And in our product, sometimes it declines. During your product stage of decline, you want to win back your customer by re-engaging them and pivoting your product or reinventing your product to further improve it. The market is where the buyers and the seller meets to buy goods and services, hopefully at an agreeable price between the parties. And it can be in a geographical area for a specific category of product. So a market segment is a subset of these buyers and sellers in this marketplace, and as mentioned, could be geographically divided or functionally divided, such as a specific game area, and in places such as Korea and Japan versus in US. Now, the product market and the product scope are related because they affect each other. So depending on which segment of the market that you are targeting, it would influence the type of function scope that meets that segment. On the reverse side, if your market segment requires certain types of functionality, it can affect the product scope for the development team to compete and be successful when you sell it to in the marketplace. Next is the ecosystem. So there are 4 kinds of competition. Direct competition, which is straightforward between Coca-Cola and Pepsi, which compete between 2 similar products. And indirect competition, which can be between 2 unrelated products but similar in replacing the value for the user. So between the Grab, which is a private car hailing service, versus a Blue SG, which is a car sharing service, or between Hertz, a car rental, and a Caro, which is a second-hand car salesman, which can solve the problem of the user, and between Netflix and MediaCorp, which is a global versus a local product. So you can also look at competition in the future, such as robotics, Asimov versus Atlas versus Optimism. So there are other competitors. If your price is too high, customer can try do DIY, or they just don't rent a private hire car, they just walk or do a DIY. Let's look at two examples.
This guy's company was nearly destroyed by Apple. Now it's making billions by beating them. Min Kao excelled as an engineering student in Taiwan. After graduating from the University of Tennessee, his work on cutting-edge tech for both NASA and the US Army gave him his billion-dollar idea to make GPS technology available to everyday consumers. Min teamed up with Gary Burrell in 1989 and launched a company. They called it Garmin since it used both their names. After building their first GPS unit, it looked like the company was doomed since each unit cost $2,500 to make. But the US Army was happy to be a customer. With this major client keeping the lights on, Gary and Min were given the time they needed to make GPS tech affordable. By 2000, the company had $220 million in sales and went public on the stock market. Paper maps had become a thing of the past, and millions of people around the world were using Garmin's devices to get around. But then Steve Jobs stepped on a stage and changed the world. When the iPhone was announced, it became clear people wouldn't need to buy a Garmin GPS anymore. It caused revenue to plummet 20% in 2009, but then an unlikely lifeline came out of nowhere. A group of runners in the company suggested Garmin pivot into fitness trackers. The company touted its sophisticated technology to appeal to hardcore running enthusiasts. While Apple would challenge Garmin again years later with the Apple Watch, Garmin is the market leader today in smartwatches that cost over $500 and boasts a market cap of $21 billion.
It's hard to compete with the big boys, Apple and Google, so good luck, Garmin. Here is another example.
But we do have one more thing. I present to you the Apple Vision Pro. About time Tim finally joined the mixed reality headset space. We're already on MetaQuest 3. Well, we're not exactly marketing this product as just a VR headset, but rather a spatial computer that can do everything between work and play in the highest premium quality. We have the highest pixel resolution per eye, the widest field of view on the market, and a fully controller-free three-dimensional user interface. No physical controllers? Sure, our specs might be a bit lower, but in terms of VR gaming, I don't know what Apple Arcade has going for it, but our users have access to the Meta Games library that has 500 titles, including games like Beat Saber and Super Hot VR. Well, we're expecting developers to create new games and immersive experiences on our Vision OS once we launch the product next year. Plus, when you sync your Vision Pro to your iPhone or Mac, it will have access to way more productivity and entertainment apps. Okay, well, how much are you charging? Starting at just $3,499, you can experience a seamless experience between the digital world and the real world. Wow, shocking. For $3,500, you can also get our lightweight and ergonomic HoloLens 2. It remains a favorite among enterprises in manufacturing, engineering, construction, and even healthcare. Wait, who invited this guy? Didn't you resign last year due to sexual misconduct allegations? No offense, Microsoft, but you guys should really just focus on the cloud and leave the goggles to the rest of us. As I was saying, our MetaQuest 3 starts at $499, which is a seventh of your price tag, and even our MetaQuest Pro is only $999. Well, we feel that our tech and design is superior and will revolutionize the spatial computing space. Just wanted to pop in and say our Google Cardboard is only $999. Not even in the same playing field. Talk to us when you've released Project Iris, okay? You just wait.
So I hope you enjoy that. The big boys are in the high stake of VR, where the TAM or total addressable market is huge. So you have Apple, Meta, Microsoft, and of course Google. So if you have a strategy, you have to analyze your competitors and identify your competitor and advantage. So you can look at this from two points of view, the industry or the market. So in the industry, you survey all the participants and you look for your differentiator, how your entry and exit market works, barrier works, your vertical integration, whether you're global or local, and your cost structure, and you can compete in each of these to differentiate yourself. Or you can look at the market where you see the value proposition, how you satisfy the customer needs, and compete from that perspective. So analyzing competition is important. You can use a paddle diagram to help you analyze your competition. And each paddle here refers to a segment of your customer. And you can look at direct competitors, indirect, or other alternatives for each paddle. So let's begin with the e-commerce. This is the e-commerce competitor participants. You can see Amazon online versus partial hybrid online such as Costco and Walmart, and there is China version, Korean version, Southeast Asian, Latin America, and so on. The pedal for streaming competes between Disney, Netflix, Warner Brothers, Paramount, and of course there are local versions of this in each country as well. The market leader for cloud platform is AWS, Azure, and Cloud, Google Cloud. And the China and the others are all single digits.
Here are the social network trends.
So here is the advertising revenue, and Google is of course the lead here, and Meta is close by, and Amazon is also nearby. You can look at most popular top ranking apps if you produce your apps on some of these platforms, and it can help you look at the local versus the global version, and look at your competitor analysis and what areas, industry they are in, what segment of the pedals they are in, and how you compete with them. So when you look at the competitors, there's analysis on the competitors. You can also look at the whole thing as an ecosystem and how each of these ecosystem works. So there are few participants in the ecosystem. There's the keystone, dominator, and niche. Keystone and dominators are two participants who controls a major part of the ecosystem. The keystone would try to provide benefits for more players to come in so that they can improve the whole ecosystem. So an example would be like Google Android, and they make it easy for everybody to participate. The denominator is like Apple. It's similar to Keystone, except it controls a lot of the space, and sometimes it competes and kills off the weaker players. And it is useful because it provides more stable and high quality product. Niche player, which are all the other rest of the participants in your ecosystem, usually compete in that niche, and they may try to compete with the denominator on Keystone and could be killed off very easily, or they stay within their niche. And you can see the platform is a very lucrative software service, and they control and they command a lot of their revenue from the platform. Here are the lists here, Apple, Google, Microsoft, Meta, and then the China version, Tencent and Alibaba. So if you look at the Keystone and the denominator ecosystem, the Apple and iOS ecosystem, they are almost invincible, very hard to compete with them. So how do you compete, or how do you bring them down? One way to do it is, of course, the government anti-competitive measure.
We allege that Apple has consolidated its monopoly power, not by making its own products better, but by making other products worse. Apple carries out its exclusionary anti-competitive conduct in two principal ways. First, Apple imposes contractual restrictions and fees that limit the features and functionality that developers can offer iPhone users. Second, Apple selectively restricts access to the points of connection between third-party apps and the iPhone's operating system, degrading the functionality of non-Apple apps and accessories. As any iPhone user who has ever seen a green text message or received a tiny, grainy video can attest, Apple's anti-competitive conduct also includes making it more difficult for iPhone users to message with users of non-Apple products. Now, having monopoly power does not itself violate the antitrust laws, but it does when a firm acquires or maintains monopoly power, not because it has a superior product or superior business acumen, but by engaging in exclusionary conduct. As set out in our complaint, Apple has maintained its power not because of its superiority, because of its unlawful exclusionary behavior.
So in the high stake of platforms, monopoly and antitrust is a weapon that you can use, and all players do that. Apple, Google, and so on. And a lot of these companies are U.S. companies, so the European governments uses this as a way of dealing with it. Of course, China, and we will look at the next step, which is semiconductor, and semiconductor give an illustration of how governments in countries handle competition in this manner.
Top players in Japan's semiconductor industry. These companies were able to produce DRAM chips more efficiently than their American counterparts, largely due to Japan's superior manufacturing processes and quality control systems. Japanese firms also adopted a long-term investment strategy focusing on improving production yields and reducing costs. By 1983, Japan overtook the United States in DRAM production, marking a significant milestone. Japanese companies held nearly 50% of the global semiconductor market share, with their dominance particularly pronounced in memory chips. Then in 1986, Japan reached the peak of its semiconductor dominance. That year, Japan controlled over 50% of the global semiconductor market, with NEC, Toshiba, and Fujitsu leading the charge. Japanese companies had successfully outmaneuvered their American rivals in the DRAM market, where they enjoyed a significant cost advantage. However, this success also attracted scrutiny and concern from the United States, which feared losing its technological edge. This led to increased tensions between Japan and the US, culminating in the 1986 US-Japan Semiconductor Agreement. The agreement forced Japan to open its domestic market to foreign semiconductors and imposed export restrictions, which ultimately slowed Japan's growth. This occurred because as Japan came to dominate that semiconductor industry, the United States government had accused Japan of unfair trade practices, claiming that Japanese companies were receiving government subsidies and other forms of protectionism that gave them an unfair advantage. Thus, the very 1986 agreement was signed.
Okay, you can see this is one of the reason why Japan semiconductor has its downfall, and here are others.
Also, its inability to adapt to emerging markets within the semiconductor industry. During the 1980s, Japan excelled in memory chips, particularly DRAM, but it failed to capitalize on the growing importance of microprocessors. Microprocessors were becoming increasingly vital to industries such as personal computing and consumer electronics, and American companies like Intel quickly seized control of this market. Japanese companies, however, remained heavily invested in memory chips and did not prioritize diversification into microprocessors or other more advanced types of semiconductors. This focus on a single segment of the market made Japanese firms vulnerable when demand for DRAM began to stagnate and when American companies began to dominate the more lucrative microprocessor market. Additionally, Japanese companies were slow to embrace the fabless model, which had gained traction globally. In the fabless model, companies focus on semiconductor design and innovation, while outsourcing manufacturing to specialized foundries. Companies like Qualcomm and Broadcom flourished under this model, but Japanese firms, which had historically emphasized vertical integration, were hesitant to adopt it. This left them behind in terms of innovation and market responsiveness.
Okay, so you can see that there are other reasons why Japanese semiconductor fail, and the rise of another country. So let's continue.
Taiwan Semiconductor Manufacturing Company revolutionized the semiconductor industry with its fabless model. Rather than producing its own chips, TSMC focused on manufacturing semiconductors for other companies, which allowed it to scale quickly and become a leader in the foundry business. Japanese companies, by contrast, clung to their vertically integrated business models, which made them less flexible and less competitive in the rapidly evolving global market.
Okay, so you can see the semiconductor value chain is complex. There are many players, and it's high stake with high investment that few companies can stomach. So you can see the players here in this list is quite complicated. And who is the winner? Recently with LLM, NVIDIA seems to be the winner, and all the partners and the customer suppliers, they have specialist suppliers. So you can see from this list here, and you can see the evidence of their success from their stock price. Okay, so the ecosystem is important. Here is an example of the Singapore e-commerce ecosystem. If in your project, you might want to come out with your own list and evaluate your industry competitors and how your competitive advantage is compared to them. You don't have to be the best of the best. You just have to be better than the competitor. So that is if you want to compete in that manner. Here are other ecosystem. This is the digital banking, where you have neobanks which compete against the traditional brick and mortar banks who has not changed yet. So neobanks are competing, and I've heard recently that a lot of these neobanks are not making money. However, they do have some of them do come from other industries, so they are supplement to their existing product list that they are doing. So this is Asia, and you can see from this list there are quite a few players: Stripes, KakaoTalk, Rakuten, and so on. So here we will look at one strategy on how to handle ecosystem competitors.
Rise of vertical AI, and it definitely parallels what we saw with vertical SaaS. So 10 years ago, I was working in venture capital, and at the time, SaaS was like super hot, and it was really hard to get into deals, and all the deals were, in our perspective, super overvalued. So we started looking more at vertical SaaS. Funnily enough, everyone had the same idea, so then everyone started looking at vertical SaaS. And what vertical SaaS means is you apply SaaS into kind of more of a niche sector that has unique needs. And essentially the reason why you want to have vertical SaaS is because these industries tend to have unique workflows that you have to build for that general tools don't really serve super well. So we're starting to see the same exact thing happen in vertical AI. So all these companies have discovered, general AI is pretty freaking competitive. So they want to apply AI into a vertical space where the people in those verticals may not think that the general AI tools serve their needs well enough. So a couple examples of recent raises. Numeric raised $28 million from Menlo Ventures to go after the accounting space. This other company raised $10 million to go after the computational biology space. And then Basecamp Research raised $60 million to basically compete with AlphaFold. So I would consider all of these kind of vertical AI solutions, except maybe Basecamp, because they are kind of doing something a little bit more general and super large. It's a gray area. So is there anything we can learn from the vertical SaaS history and apply it here to vertical AI? Well, I think in the vertical SaaS space, what ended up happening is VCs threw a lot of money at all kinds of vertical SaaS companies in the supply chain, in transportation, and healthcare. And some of them panned out and some of them didn't. And I think a really big reason why certain vertical SaaS companies don't pan out is because they go after too small of a market with too much money. So I think it's possible that that's going to happen to a lot of the vertical AI companies that are raising right now, that may be raised at an amazing valuation, but are targeting too small of a market. So we'll see if that pans out.
Okay, so hope you learned something from that video. AI is the hottest topic. Everything you want to do in AI, writing a paper, getting a grant, getting VC funding, you put the AI in it, they work. However, there's too many people going to different areas, so you can niche your AI in like accounting or biological science, or in this case drugs, preclinical drugs, or manufacturing, or in your area of specialty, whatever, teaching in AI and all that. But then when there's too much money, the danger is you have to look at the total addressable market, TAM, which we will cover later, which if it's too small, the money in there is not good enough. Okay. So one strategy to look at is to avoid a crowded market, or the red ocean strategy, which is competing with existing market space, understanding the competitors and all that. And you can use a different type of strategy called the blue ocean strategy, where you actually go and create your own market, test it. So in an existing incumbent group of people, you want to use this ERRC method, which is you eliminate existing structures. You try to remove what the existing structure is trying to do. You try to reduce what is commodities and abundance of talent or whatever, and then you try to raise the part that is important, and then you create new factors in the industry. And the example given in this blue strategy by the paper from Kim and Moboch is the Marvel Studios on the Hollywood way of making movies, where they reduce the full price movie stars and middle management, and then they focus on creativity and so on. So that's the example used there. So now let's focus on financial management. As a product manager, you don't need to look at the financial part of your product. You need to have a financial model in your business plan, and this is the number that reviews your cost and benefit to lead you to a profit. So in your business case, you need to compare all these costs and benefits. You need to look at assumptions, investment, projection, cash flow, and risk, manage the risk and contingency. The income statement is an important statement that shows you your bottom line. It lists out the incomes and expenses over a period of time, which tells you your P&L, usually over quarter or annual, yearly. So your revenue minus your cost of goods will give you your gross profit. A lot of companies are growing in their revenue but not growing in their profits. So your product, you need to look at whether it is bleeding money, investor money, or it is actually making money. So you need to minus the operating costs, OPEX, and it will give you your operating income, EBIT. And when you minus off the non-OPEX interest rates and so on, you will get a EBITDA, which goes down to your net income, the bottom line, and that's the most important number there. You also need to look at your balance sheet, and your balance sheet is how much your organization is worth at the time. So you look at all your assets, liability, and equity. So your assets equals to your liability plus the shareholder equity. So on your left side, you look at the assets, your current assets, and your long-term assets. This includes your cash and your long-term investments, your fixed assets. Depending on, in software, there might be less fixed assets unless you have IP property. Okay, so your liability could be short-term payables, long-term payables, or shareholder equity, and that includes retained earnings, stock options, and so on. So you need to manage those as well. Lastly, one most important thing is your cash flow. You need to know what is your current cash moving in and out, because if you don't have a good cash flow, you could be losing a lot of money and you could go bankrupt. So you look at the operating activities, the net profit income, minus and plus all the working capital changes, and if your customers are not paying you in time, you do have to pay interest rate, and all those comes into effect. So you also deal with investing activities. A lot of unicorns, they get a capital injection, and before they use those capital injection, they could actually invest them and make good interest money out of those investments. So financial activities, if you don't have a good capital account cash flow, you have to pay interest and debt and dividends, and that can cost a lot. The income statement, cash flow, and balance sheets come together. So in your income statement, you start with your revenue and you end with your net profit, and your net profit is the starting point for your cash flow, and you end with your cash balance, and the cash balance is the starting point of your balance sheet. and it ends with the return earnings, and the return earnings is used as part of your revenue and goes in a cycle. And these 3 documents are used by different investors, and depending on whether you're a value investor or a growth VC investors, you look at different parts of the document as described in that slide. So let's look at a typical startup financial statement.
Startup's journey simplified. Startups typically operate within a 10-year time frame. That's because they get funded by venture capitalists who raise a fund that's typically in a 10-year period. In the early stages, years 1 and 2, startups typically try to get product market fit by first building out their product. Because of that, you'll see a heavy investment in research and development. After that, in years 3 and 4, this is all about validating the technology and ensuring that everything that they built and spent money on is actually what the customers want. In years 5 through 8, these are what we call the growth years, where the startup then tries to really achieve mass adoption of their product or service. They try to get big, sometimes at all costs. The idea here is to capture as much market share as possible and grow revenues really, really large. Finally, in years 9 and 10, this is when the startup aims for profitability or break even. This is also when they start to think about a sale or potentially even an IPO.
So you can imagine a startup takes 10 years to be profitable. Some companies take longer than that. So how do you price your product? It can be based on cost or can be based on value. Cost will be based on how much it costs you to make the product. In software, it can cost little, but you do need to have R&D and development costs and licensing costs. And you price it a bit above your cost or a lot above your cost, and that depends on how much volume you want. So in a value base, you look at how much value it creates for the customer, and you give a discount to the value so that the customer will buy it. So in this slide, we will look at how a Y Combinator speaker talks about what we discussed earlier in the previous slide.
When you price something, there's actually like 2 other factors at play. There's the cost, there's the price, and then there's the value. And the interplay and relationship between these items affects how growth happens inside of your company. Now, the gap between price and cost, that is your margin, that is your incentive to sell. The bigger that gap is, the more you are driven to want to push your product to your customers. This gap here between price and value is incentive to buy. And the larger that gap is, the easier it is to have your customers want to sign up or use your product. To figure out price, there's really 2 ways to go about it. You either start with the cost and you figure out where your price is based off of that. That is called cost plus. The other way to do it is figure out what is the value of your company or product or service, and then you figure out your price from that. And that is called value-based pricing.
So it is important as a product manager to understand how to price your product. So now that you understand the financial statement of a product, how do you evaluate a tech startup? So let's listen to an investor, Peter Thiel, talks about this valuation, whether you're a growth or a value investor.
One way to think of this last mover value is this idea that most of the value in these companies exists far in the future. If you do sort of a discounted cash flow analysis of a business, you have sort of all these profit streams, you have a growth rate, the growth rate's much higher than the discount rate, and so most of the value exists far in the future. I did this exercise at PayPal in March of 2001. We had been in business for about 27 months, and we sort of had, the growth rate was 100% a year, we were discounting future cash flows by about 30%, and it turned out that about 3/4 of the value of the business as of 2001 came from cash flows in years 2011 and beyond. And whenever you do the math on any of these tech companies, you get to an answer that's something like that. So if you are trying to analyze any of the tech companies in Silicon Valley, Airbnb, Twitter, Facebook, any emerging internet companies, all the ones in Y Combinator, the math tells you that 3/4, 85% of the value is coming from cash flows in years 2024 and beyond. It's very, very far in the future. And so one of the things that we always overvalue in Silicon Valley is growth rates, and we undervalue durability. Because growth is something you can measure in the here and now, and you can always track that very precisely. The question of whether a company is still going to be around a decade from now, that's actually what dominates the value equation, and that sort of is a much more qualitative sort of a thing.
So are you a Warren Buffett value investor, or are you a Silicon Valley tech investors who bet a lot on the future earnings, like Peter Thiel talks about 85% later down in the timeline. So here is the pricing for video streaming. So if you look at video streaming, these are the competitors: Netflix, HBO, Hulu, Disney, Prime, Apple Plus, and they all price their subscription fee at a certain price, and that affects their bottom line, their income statement. So it is important when you compete to understand how they do pricing in order to gain market share. So another example of pricing strategy is using the EV market. So Tesla has a very high margin profit-making company, and look at how it has reduced the margin to gain more market share. And this is done by cutting room, and a lot of people, including Tesla investor, are a bit skeptical about this, but we can understand this by listening to Elon Musk talks about pricing. So here is Elon Musk talking about pricing for Tesla when they reduce the price.
The desire for people to own a Tesla is extremely high. The limiting factor is their ability to pay for a Tesla, not do they want a Tesla. It's easy for people in this room to lose sight of that. If your income is far in excess of what a car costs, then you look at value for money, but you do not consider affordability. But for the vast majority of people, it is affordability driven. This is why we cannot simply double the price of the car. Or you could say and think about things in the limit, where if you had an infinitely desirable car, but it costs $10 million, it wouldn't matter because most people do not have that. So demand is very much a function of affordability, not desire. Very important. One of the things we weren't sure about was the price elasticity of demand for Teslas. So like, as we lower the price, how much does demand increase? And we found that even small changes in the price have a big effect on demand, very big. So that was a good thing to learn.
So if you look at Tesla, they reduce the price because they believe the price elasticity, as you reduce, you will increase volume, and the volume will compensate for that reduction. And you can see how price strategy is important in EVs, and if you have competitors in streaming, it is also important. Okay, so now let's look at the total addressable market, or TAM, and a lot of companies talk about your total addressable market in your proposal. You look at this. So it is one thing to understand whether you create value, is another thing to understand whether there is a total addressable market or available market that is sustainable for your company based on the cost that you are investing in. So we will now go through KPI very quickly. So in KPI, we can look at 4 factors: financial, internal process, customer perspective, or innovation learning perspective. We will not go deep into any of these, so the slides is enough to understand them. So in a performance, you look at the metrics depending on which category that you are looking at in your product life cycle. So in acquisition, you sign up, you look at customer acquisition costs. When you're activation, getting people to commit to your product, you look at activation rate, free to paid, When you're looking at engagement, you look at monthly active users, weekly active users, stickiness, feature usage. So these are all KPIs that are used, production performance management, that are used by different IT companies. And there are links in the page, these slides that explain, go further on each of these in detail. Now we will cover the risk very briefly. There are three kinds of risks you can look at: product risk, customer risk, or market risk. So the product risk is whether you are doing the solution that fits the problem. The customer risk is the product market fit, and the market risk is the growth phase, where you look at how are you growing at the pace that you should be growing. So in your exercise, when you're doing your product strategy in this segment, you look at your previous business model and your market, and you try to identify the market segment, look at all the competitors, direct or indirect competitors, understand this for each of these segment using the pedal diagram. And if you want, you can go think of a blue ocean strategy instead of a red ocean competitor analysis. And then you plot your ecosystem. Who are the different players involved? Are the key stones dominator? And how do they coexist in this ecosystem? And where can you fill in the gap? So it is important for you to understand how your product fit into all these Red Sea competitor analysis or an ecosystem and your gap analysis in there. And you need to have a income statement in your strategy to understand how your product can become profitable. In 3 years, it's hard to be profitable, but in this project, we're looking at your 3 years. So you need to present your market segments, ecosystem, competitor analysis, and income statement. So here's where we end. Bye.